education series, one of the flagship of the Broad Street Radio, is coming to you this day from Broad Street Radio. And we also want to educate you, tell you a few things that you need to know about the market capital and the market monetary. The topic is the effects of recent monetary policy rates on Nigerian equity market. The truth is that capital market and money market are two sides of the same coin. And of course, one can't do without the other. It's like a coin. There's no coin with one face. Two faces of the same coin. Capital, money market. Now, the truth again is what happens to one affects the other. Sometimes negatively, some other times positively. When there is a hike in interest rate, it ought to affect the equity market, and it does affect the equity market. Now, recently, the Central Bank of Nigeria hiked the interest rate. Not just recently, over months. In the course of the year, it has been hiked 3 times. The last was 18% to 18.5%. And you want to know what is the effect of this. Now, when the interest rate goes up, ordinarily, it's expected that it becomes more attractive to leave money in the bank, in the money market, than in the capital market. Because people are ever hunting for where to put their money to earn the maximum income. People who have money are moving their money from one to the other. So when you hike an interest rate from even 500 basis points, like we had before, 50.5 alone could make big money investors to move their investments from one sector to the other. So essentially, you expect that the market responds appropriately by going towards the money market because of the hike, because it becomes more attractive. So stock performance is affected because sometimes they offload from stock to go to money market, and that is the major effect. The next thing is that investors, there's a sentiment whenever monetary policy is affected, either up or down. The sentiment is more of their understanding of the market. What is the understanding of the investor? When there is a change in monetary policy, if he feels that it is used to chase inflation like they have done in the time past, the response to it is not quite as it ought. But if they think that it is a judgment, positive judgment on the market, the chances are that they will remain where they are, knowing that the market is moving. Now, domestic investors behave alike, just like the foreign investors. Foreign investors are hunting. You know, there are certain climes, not a lot of areas in the world where they have single-digit monetary policy. 5%, 3%, 2%. Now, some people move from such places, borrowing from there, bringing it to where they can earn higher. But there is also foreign exchange risk that is involved. It is when you want to reconvert to where you are taking it from that risk becomes manifest. But people who play in that market know better. But the fact that there's a hike in the money market rate, brings attraction to that market because people want to earn more. Foreign investors also come in. Thank God for today, the market is such that it's just a punch away. If I want to move money from America to Nigeria, it's just a punch away. The moment I touch the appropriate button, it goes. That's how the market has become. You know, the market is interested now. There is hardly a barrier. You know, we have often heard the world is a global village, but today we know it better. That's a touch of a finger. The money moves to the other nation. Now, there are sector-specific investments or stocks that are affected even the more. What do I mean by sector-specific stocks? There are certain stocks that there is heavy borrowing on. Construction business, all things about building and road, there is very heavy reliance on borrowed money to execute them because they are big ticket projects. Now they are also affected because in this case, when they are tied in. There's no way to go. Even if you hike interest rate, they may remain. So there's a response that comes from there. Now, whenever such things happen, people move from one sector to the other. What I want you to understand today, particularly from layman's point of view, is that money market, capital market are two sides of the same coin. When one goes up, the other one seems to go in opposite direction, and the other one comes down because somebody has hiked up the rate. Now, what is the rate of the recent monetary policy? Because it was a hike of 500 basis points from 18% to 18.5, is expected that the market responds appropriately, even though it's not a very big jump. But in the Nigerian sector, because our systems are not well aligned, if it were in developed climes, that would have been very big, because there is hardly a 1% jump in monetary policy in all these developed countries. But in Nigeria and other developing countries, can you imagine inflation rate of 22%? 22% inflation rate tells more on what is the return on investment at the end of each month. So be educated, know what I'm explaining. When there is hike in monetary policy, the tendency for money markets to be more attractive than the capital market is high, depending on all other factors. There are so many other factors around it. Is it possible then that money moved from money market, or capital market rather, to the money market? Not too much. It didn't quite happen in this season. Maybe because that 500 basis point was not too big a move. And of course, the peculiar nature of developing economies like Nigeria, where things are not aligned properly. Because they are not aligned properly, fine-tuning is needed if you want it to respond to the stimulus that is being introduced into the market. Once more, I think I have made it a little better for you to understand what happens when there is effects and the effect of the recent monetary policy on Nigerian capital markets or equity market. Thank you once more. I'll come your way again next week. Thank you.